learning objective 2, or module 2 of chapter 3. We're now going to define and apply the time period concept, revenue recognition, and the matching principles. As we left off in module 1 of chapter 3, we noted that the revenue and expense recognition that is used under generally accepted accounting principles is based on the accrual basis of accounting. Under the accrual basis of accounting, we recognize revenue when it is earned, regardless of when cash is actually received. Recognizing revenue when it's earned must follow the revenue recognition principle. We'll also recognize expenses when they're incurred under the accrual basis of accounting, and that's regardless of when cash is paid. Recognizing revenue when it's incurred is based on the matching principle. The time period concept comes in because we need to accrue revenues and expenses under the accrual basis, because in order to satisfy user needs, we have to artificially truncate the life of the business into artificial periods of time. And the conceptual framework for accrual accounting and the need for these year-end adjustments is going to justify the accounting that we're going to be using beginning to, now and throughout the semester. So what is this time period concept? Well, as we mentioned, the time period concept or assumption, or sometimes called periodicity concept, is actually based on the fact that users need information on a timely basis. If we think about the way accounting used to be employed when we had venture accounting, we would wait until the venture was terminated or all assets were liquidated and turned back into cash in order to get the true profit of the business or the true loss of the business. So in other words, if you started a business 10 years ago with $100 and you now terminate with $9,000, that means that you earned $8,900. And that's known as venture accounting. And venture accounting was used for expeditions that were financed by governments, people exploring the world at that time, or certain parts of the world. In trade, they would send out a group of individuals. They would be paid based on what they brought back in terms of goods and agricultural products. And the person that was sponsoring the expedition would determine his or her profit by looking at how much they paid for the expedition and how much was returned. Now, obviously, this is not going to be very useful in decision-making in today's economic environment. Today, businesses need information. Investors, creditors, and government and society in general cannot wait until the end of the life of each business in order to get financial information. So therefore, as a result of the environment in which accounting operates, we demand information on a timely basis. In order to make information useful, if you remember, when we first looked at the conceptual framework, we said that useful information was needed, and useful information had two primary qualities, and those were relevance and faithful representation. So that when we look at the notion of useful information, accounting information is useful if it is capable of making a difference in decision making. Timely information is relevant information, and that's one of the qualities that makes information useful. The other quality of useful information, so relevance is one, and the other is faithful representation. Faithful representation means that the accounting numbers are faithfully representing the underlying economic event that they purport to represent. So timely information is needed by the IRS. They can't wait until your business liquidates in order to provide you with information. The SEC, as we mentioned earlier in the course, will have information that needs to be provided by filling out or completing Form 10K, which is quarterly, and 10Q, which are the annual reports. So to satisfy new user needs, we have to use the time period assumption to artificially truncate the life of the business into artificial periods of time of equal length, months, quarters, years, and this is the application of the time period assumption. By definition, the time period assumption assumes, now remember, this is an assumption because the life of the business really spans its entire existence. But we assume that the life of an economic entity, of a business, can be divided into artificial periods of time, equal length, in order to provide reports regarding the economic activity of that entity. Applying the time period concept requires that we use the accrual basis of accounting. When we look at these accounting periods, you have to remember that business activities will be separated into small segments, artificial periods of time, specific time periods like a month, quarter, or year, and we're going to obviously need to prepare reports as of that point in time. Now, an important point to note here is that a company's fiscal year is not always the same as a calendar year. A lot of nonprofit or government organizations have a fiscal year that begins July 1st and ends following June 30th. So the beginning of the year is July 1st, the end of the year is June 30th. Now, to apply an example, let's go to the whiteboard. Let's try to apply an example using that calendar. When we looked at the calendar, let's assume that our reporting period is going to be 1 month. So let's assume that we prepare financial statements or prepared monthly. And let's assume that you have a weekly payroll of 400 per week, or $80 a day. And let's assume it's paid in cash on Friday. Now, I'm going to use this to illustrate the accrual basis and the need to invoke the time period assumption. If we look at the calendar that we had, we're preparing monthly financial statements. And the week, the last week of the year, last week of the month, I should say, is October 31st. And this is November 1st. That's November 2nd. Economic activity takes place. So every day you owe someone $80. Payroll is paid on November 2nd. And the total is 400. Now, here's the issue. If you report for October and you're preparing monthly financial statements, the company would have to show on the accrual basis have a salary expense of $240. In November, so far, salary expense is $160. And this is on the accrual basis. So if I'm preparing financial statements under the accrual basis, I have $240 of salary expense in October. In November, I have $160. What would happen if I use the cash basis? Because nothing's paid in October, we would show 0 salary expense in October, and we would show $400 of salary expense in November. Clearly not matching the economic activity. The economic activity that took place in October is clearly 3 days work, and by using a cash basis, it would appear as if no work was done in October and all the work was done in November. So clearly the time period assumption will cut the life of the business into artificial periods of time, and as a result, it will properly measure revenues and expenses in the periods in which they were earned, and in this case, in which the salaries were incurred. So the time period assumption simply states that it's appropriate for a company to report information at predetermined time intervals. And again, our example here was a month. I said, we mentioned before that companies could have fiscal year ends that are not the same as calendar year ends. So not all their companies begin on January 1 and end on December 31st. As I said, some companies and government might have a July 1 to June 30th. Here, agriculture, based on the type of business that they have. I mean, remember, a lot of businesses will, the typical, by the way, the typical January 1st to December 31st year end was built off of the retail, manufacturing and retail, because that's when their sales would slow down, and at the beginning of the year, and they would peak at the end of the year, and then they would move to a new business cycle. And the same thing here, if you look down on the bottom at the agricultural industry, that probably the beginning of the year when they just get started is April, and then the following March would be after they have harvested and sold all their products. Now, the application of the time period assumption in this case is going to force us, as I said, to use the accrual basis of accounting. And the fundamental principles of accrual accounting are the revenue recognition concept and the matching principle. The matching principle is also known as the expense recognition concept. So let's take these in order. First, revenue recognition. In order to recognize revenue under the revenue realization principle or the revenue recognition concept, and by the way, these are synonymous: revenue realization, revenue recognition concept, or principle. It's recognized when 2 steps are satisfied, or 2 elements are satisfied. The first element is that an exchange has to take place and the earnings process has to be substantially or essentially completed. The earning process is complete when there are no significant uncertainties as to future costs to be incurred and as to collection. So that you need an exchange and a completion of the earnings cycle in order to recognize revenue. The earnings process is also noted to be complete when the seller has delivered the product or service and nothing else remains in order to sell that product. Revenue is recognized when it's earned, as I said before, regardless of when cash is actually collected. So to summarize the revenue recognition concept, revenue is recognized when it's earned. So a good or a service has been delivered, so we have an exchange. We exchange goods for the promise to pay, or goods with the cash being collected, and the earning cycle is complete. When the earning cycle is complete, there are no material uncertainties as to future collection and future costs to be incurred. And thinking about the future cost, let's just go back for a second. We know collection is one issue. But what are future costs to be incurred under the revenue recognition concept to complete the earning cycle? Well, one would be a warranty. Most businesses can estimate what their future warranties will be. So when you buy a product, you usually get a warranty for 1 year. You buy a car, you can get a warranty for 3 years. So essentially, we note that warranties exist and there are no significant uncertainties for most companies because they have experience in selling the product and they realize and they can estimate with a fair degree of accuracy how much it's going to cost them to service those products in the future. Collection, we'll see in this course that companies have the ability to determine how much of their receivables will not be collected or how much of those receivables will be bad debts. So going back to our summary, then we know that we have to have an exchange. And the earning cycle is complete. Earning cycle is complete when there's no material uncertainty as to future costs to be incurred and as to collection. And of course, the amounts of the revenues that we recognize at the actual selling price. So if an item is listed at 200, but if you sell it for 100 based on a discount, maybe it's a discount for a frequent buyer, the selling price then is 100. And it's based on the cost concept. Now, for recognizing expenses, expenses are recognized only in the period in which they're incurred, but we tend to tie this to match with revenues. So basically we say that expenses are recognized only in the period in which the benefits are received. And we recognize revenue in the period that they match with benefits received, regardless of when they're actually paid. So for example, expensing a sales commission in the same period when the sale is made makes sense, not necessarily when the sale is collected. That is an example of the matching principle. This is a very good illustration of matching. You sell something today, your salesperson earns commission, revenue is recorded, and the expense of the sales commission is recorded. Expenses follow the revenues, or expenses will match with the revenues, even if the sale is not collected, and even if the commissions are not paid, even if, again, the sale is not collected, and even if the commission doesn't have to be paid, even though it's earned, it has to be, or because it's earned, even though it's not collected, it has to be recorded. Now, it's not always easy to match costs with revenue. Sometimes it's based on time. So, for instance, insurance policies expire at the end of each month. It's not really easy to match that expense with a particular revenue. So that if you're paying insurance on your car and your car is used for deliveries, or you have a truck that's used for deliveries, it's not always easy to match the insurance with particular sales that you make. So we usually will have our insurance expense based on time. So you have an insurance policy. Let's say you pay $3,000 for a 3-year policy. You'll have an insurance expense of $1,000 per year. Insurance coverage is expensed as it's going to be used. It may not be easy, as we say, to relate this to a particular revenue. And finally, this matching principle can be summarized by saying that expenses are recorded when they're incurred, but they are matched with the benefits that are received. So, for example, a rent expense for January should be matched against revenues in January, even though if it's prepaid in December. So if you pay your rent a month early, then it's not an expense because you didn't occupy the office space or you didn't occupy the store that you're renting until January. So regardless of when you pay, you have to match it with the revenue. So for example, if this was a store and you rented the store, and let's say this is 2014, this is 2015, you paid the rent, you paid January's rent here. You have sales in January of 2015. Therefore, the rent only is expensed to match against those revenues because that's when the store was open for business and that's when you sold those products. So the rent paid in December or paid in advance is not an expense. It's only expensed when it's used up. So in this module, we looked at the time period assumption, which states that the economic life of the business can be truncated into artificial periods of time. That requires that we use the revenue recognition principle. The revenue recognition concept is going to result in recognizing revenue in the period it's earned. It's also going to be resulting in us using the matching concept. And again, we're matching with the benefits here. So the idea is the expenses are matched in the period when they generate revenues. That's when the benefits are received. Now, going back to the whiteboard for a second, let's just realize that now at the end of the accounting period, going back to the illustration I had before with the salaries, even though it's November, I'm going to pay $400 here. If I have an October report, I have $240 of salary expense that I have to accrue. And it is not recorded at the end of the accounting period. And again, we're assuming that the end of the period is here. So it's not recorded here, actually paid in November. Because I have to accrue this salary expense, I have to make an adjusting entry. And that adjusting entry has to be made on October 31st. On October 31st, I'm going to make the entry debiting salary expense and credit salary payable. For $240. And that's going to be for the month of October. So the time period assumption, the use of accrual-based accounting, and matching, because remember, these salaries, what if they were sales salaries? This is going to be matched against the revenues generated by the 3 days worked in the last 3 days of October. So when we move to Module 3 of this chapter, of Chapter 3, we'll be getting into the adjusting entries.